In this next lesson, we're going to be talking about order pairing. Now, with order pairing, the previous lesson we had internal and external range liquidity. This is going to be key in understanding order pairing. So what is order pairing? Understanding the liquidity requirements smart money needs for their orders, where they get in and where they get out of those positions, is a crucial fundamental understanding that is required to trust the market to deliver to those specific levels and understanding where and why it's reaching for that specific level. Have you ever had those moments where you believe price is going to reach for a level, however you abandon it just for price to eventually get to your desired location? This urge to get out of the market is on a retracement, thinking is reversing and not trusting the delivery is a lack of understanding the liquidity requirements and how the market makers will engineer liquidity for their order pairing. Again, using time frame alignments, we use a monthly PD array with a daily structure. We use a weekly PD array with a 4-hour structure. We can use a daily PD array with a 1-hour structure, and eventually a 4-hour PD array with a 15-minute structure. So price is fractal, right? So if you, for instance, are a swing trader, you're better off using a monthly or a weekly PD array and then utilizing the daily structure or a 4-hour structure. If you are more of a intraday trader, you're better off trading the daily PD arrays with a 1-hour structure. And if you're a scalper or a short-term trader, a 4-hour PD array and an M15 structure, that's good enough. So depends on your personality. If you are a swing trader, higher time frame might be better. If you are more of a scalper or intraday trader, go with those daily PD arrays or 4-hour PD arrays and their structure, 1-hour structure and 15-minute structure. So where is smart money involved, right? Smart money is involved in moves on the monthly, weekly and daily time frames. No time frame lower than these time frames they are involved because their orders are simply too large for these time frames. So when they are bullish, they accumulate their orders below old lows, and when they are bearish, they will accumulate their sells above old highs. If you are not trading off a higher time frame level, you are gambling. Right, so over here we've got a British pound Canadian dollar monthly chart, and just look at this chart and what do you see? What is the order flow right now? And where are we coming from, right? So we had bearish order flow over here. We have this massive rejection wick and then spot internal range and external range liquidity, right? So we hit that internal range liquidity on a monthly time frame. So what is price gonna be wanting to aim for next? External range, right? So we hit an internal range liquidity down here. Then we can see external range up here, external range up here. And eventually we want to reach into that external range because we go from internal range to external range. So let's zoom in a little bit more. So here we have a daily structure and we have those monthly levels annotated also, right? So we have this monthly fair value gap down here and then the buy stops also on that monthly time frame. Now looking at that daily structure, where do we want to see the order pairing happening? If your eye went to down into this low, you are correct because this is external range, right? An old low. Where are the orders being paired up? With sell stops, right? So if they are long, they want to pair up their buys with sell stops, which is down here, right? So we have sell stops down here. Smart money is accumulating down here. Why are we accumulating down here? Because there are willing sellers trying to sell this position down here. So when they accumulated all these sell stops, they're good to go into bullish order flow, and also we're coming from an internal range on the monthly time frame, right? So from internal to external again, up into this high. Smart money sells to these buy stops over here, right? So order pairing happened down here. Willing sellers entering the market. They push price up and up and up until they can offload their long positions to willing sellers. willing buyers up here in above old highs and also above old highs over here. Now for them to offload their positions, their long positions or short positions, they need to engineer liquidity prior. So how does smart money engineer liquidity? They do this by retracements and failure swings. The retracements that form these engineered liquidity pools are opportunity for us to get into the marketplace. So think about those retracements and think about those failure swings. We have had a lesson about failure swings already. That's engineered liquidity, right? Low resistance liquidity. We're going to be looking for that as a target. So same chart again, British pound, Canadian dollar, daily chart. Smart money accumulates orders down here, long orders, pairing it up with willing sell stops. Where is the liquidity forming in this range? You can spot this failure swing up here, right? So this is engineered liquidity again. So they will engineer this liquidity to run it up later. They're retracing back down lower, right? So this retracement is an opportunity to get into the marketplace and aim for this external range liquidity. How do we get in? We wait for that sell stops to be accumulated for long orders for smart money. Then we have that external range liquidity over here with that failure swing, remember. Now where do we get in? We run up into that external range, but before we do that, we need to find internal range, which is over here. We've got this fair value gap on the daily time frame. So after that accumulation of sell stops, we can push price up higher. We wait for a displacement or a fair value gap, which is down here, right? And then this is the opportunity to get in long, taking out this external range liquidity. Now price action is accumulating over here. With this accumulation, we are highly unlikely to reverse, right? Because we already accumulated the sell stops for long orders. We already repriced into this imbalance, right? Taking out external range liquidity. Now what is price doing again? Over here. Creating a failure swing once again. So with this failure swing being formed, we've got a retracement lower, right? And there's another opportunity to get in. This big fair value gap up here, still being respected by the bodies. The bodies are important, right? The wicks do the damage, the bodies tell the story. So as long as these bodies are respecting this daily fair value gap, we are still good to go into external range liquidity. So we're going from external into internal, into external, back into internal, right? And once we reach internal range liquidity, we start to accumulate here again, going again for that external range liquidity. So this is engineered external range liquidity. Think about those failure swings again, right? This high fails to take out this low, drops once again into that internal range liquidity fair value gap and pushes up price to take out that engineered external range liquidity. Above here, more buy stops are present, so offloading their long position with buy stops over here is a perfect scenario for smart money. Over here we've got a British pound Canadian dollar weekly chart. Same chart as before with the monthly fair value gap. Now we've got that weekly PD array, right? Going to a daily structure over here. We can see this daily fair value gap. This is internal range liquidity. Now where do we pair up our orders and where is engineered liquidity? Can you spot engineered liquidity up here? Yes, we can, right? Because we have failure swings up here. So there's a lot of buy stops resting above here. Now order pairing, where do we want to pair our orders? Below old lows, right? Right, so we see this old low down here inside this PD array still, right? So order pairing, we can do that perfectly on this old low. Smart money buys from these sell stops. Again, we want to be buyers up below old lows. So over here we've got these accumulated sell stops for long positions for smart money. We can see all these failure swings up here. So this is also a perfect scenario to get into bullish order flow. After smart money accumulates these sell stops over here, we're good to go into bullish order flow, spotting out these failure swings up here. So all this engineered liquidity up here is a perfect target for smart money to reach into and pair up their long orders with these buy stops above here. Looking at the 1 hour chart, we can see it a little bit more clear. So trading that daily key level, right, below an old low, which is again over here, we can see a order block being formed below this old low, pushing up price higher and then engineering this liquidity, right? So what do we wait for? We wait for a retracement into discount levels, which is down here. So everything in the red is discount here, right? And above here we have this premium level. So we can see that this old low down here, right? Where does smart money pair their orders, right? With willing sellers. Their sell stops down here. They're accumulating their long position in this area over here because it's below this old low, right? We can see the 1 hour structure is pushing up, breaking structure over here, and then this retracement is what makes traders close their position early, right? Because they don't believe price will keep continuing up, so they will close their orders. But this is a perfect retracement into the mean threshold of this bullish order block, right? So after we move up from here, we can go into that engineered liquidity retracement. So this is perfect to engineer liquidity to keep continuing up longer, because we know where are the buy stops resting, right? We have all these failure swings up here, so there is a lot of buy stops up here. So once we hit this old low, smart money reversal happens over here, we displace up higher, taking out this first engineered liquidity retracement, and we can keep continuing up into these buy stops up here. Zooming in a little bit more on this little piece of price action over here. Again, what are we forming up here, right? Also all kinds of failure swings. Now, when we expand and then start to accumulate or consolidate over here, it's highly unlikely to reverse because there is no reversal from a consolidation. Now with these engineered buy stops over here, this failure swings up here, we can assume we want to push up higher, and keep in mind this is our target, right? These engineered highs up here. We can see a little stop hunt down here or a turtle soup on the 1 hour time frame, perfect to go into this external range liquidity. Now how do we get in, right? We can see this low which took out the sell stops over here, creating a new dealing range, right? So if you take your discount and premium levels, we take this low which rates liquidity into this high which took out these buy stops over here, and then look at these highs are relatively equal, right? So our eye should eventually or immediately go into these buy stops over here. Then price retraces back into discount, into this fair value gap over here, right? And this is another opportunity to get in long and be in line with smart money where they want to offload their orders above here, above market price. So over here we have Australian dollar, US dollar daily chart. Now we can see this old high over here has been rated, so buy stops have been liquidated, and this is where smart money accumulates their sell orders, right? So what do we do after we go from external? We go into internal, right? So where is our internal range liquidity? We've got this fair value gap here, but can you see something else? What are we seeing in this piece of price action over here? Because we want to look for an opportunity to get short, right? Because we know we should not go above this. So where do we get in? We want to be in a premium level, right? So we hit that internal range liquidity and we see this low and this low. What is this low and this low? We've got this failure swing once again. So this is engineered liquidity. The algorithm will continuously engineer liquidity to pair more orders up to continue lower. Now, where do we get in if we want to participate in this move down. We want to be in a premium level, right? So we need to dive in to a lower time frame so we can see more structure, because this is the daily chart, right? So we have a more clear picture if we go into a 1 hour chart. And in the 1 hour chart, we will see this retracement into premium as our opportunity. Right, it's a 4 hour chart on Australian dollar, US dollar. Again, these buy stops, right, on the daily time frame was rated over here. We're breaking down lower, 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 breaking structure down here, and then engineering liquidity on the sell side over here. Now, how do we get in? We want to be in a premium level, right? So if we take this high to this low, that's our dealing range, and then into this retracement lies our opportunity. We've got this 4 hour fair value gap, right? Draw out your premium and discount levels. That's very important. We take out this low into this high, then equilibrium, or the middle of the range, is over here. Again, pairing up our sell orders with buy stops, just like we did over here. We can do the same thing over here in this range, right? We have these buy stops, and then with this engineered liquidity still being present, so there's still a target present down here. We can wait for these buy stops to get run into, and then this is the perfect opportunity to go into a short. And if you, this is a 4 hour chart, and in this piece of price action on a 1 hour chart, we can very highly likely find a structure shift and a nice fair value gap into premium to continue down lower, taking out this engineered liquidity or a failure swing, and then eventually into these sell stops down here. So this is a 15-minute time frame. Remember the retracement into premium, right? And the buy stops earlier. This is all in a premium range. So above here, this retracement is breaking down lower, and eventually we are leaving fair value gaps behind. This is where the opportunities lie, right? We can see this breaker block over here is also in line with this fair value gap, making it even a higher probability fair value gap. So after the buy stops got rated, we wait for a break of structure, we wait for displacement, and then draw out your New York midnight open line, right? Where are we? Are we above New York open? Yes, we are. New York midnight open price, and then breaking down lower during New York session over here, and eventually continuing down lower and lower to pair up our sell with these engineered liquidity down here, and the sell stops resting below here. Higher time frame internal range to external range, or external range to internal range, is lower time frame order pairing. So an example of this is in the next slide, is the high of a bullish fair value gap annotated by a previous monthly low is usually a structural low on the daily chart. So on a higher time frame monthly chart, price is moving from internal range, that fair value gap, remember, to external range, that was that swing high. However, on a daily chart, it's going to be below an old low, which is where smart money are accumulating long positions in what would be a turtle soup on a daily chart to distribute above those buy stops. So we've got this Australian dollar, US dollar weekly chart. Again, internal range liquidity. Where do we want to go? Once we hit that internal range liquidity, we want to go to external range liquidity, right? Where are the buy stops resting? We've got this engineered high over here. So after hitting that internal range liquidity down here, inside this fair value gap, we go again into external range, which are these buy stops above here. So this is a swing high too, right? So we have one lower, one higher, one lower, and then that gets their buy stops over here. Dropping into a daily chart over here, still having that fair value gap present from the higher time frame. We can see that swing low is being formed in a key level, also important to note. So where are the buy stops, and what can we see? We see this buy stops over here, right? This swing high. What do we have over here? Again, engineered liquidity, right? We have this failure swing over here, and again, displacement over here, an imbalance, internal range liquidity, and that's the opportunity to get in on more long orders. Smart money buys below this old low, right? So swing low down here, Smart money buys from these sell stops, and then we continue up into these buy stops over here. So over here we have a US dollar Swiss franc monthly chart, and this is going to be an example about the monthly external range to internal range liquidity. So we've got this low down here, right? This is external range liquidity on a monthly because this is a swing low. Where does smart money accumulate their long orders? Below old lows, right? So this external range, we can see this external range liquidity rate inside over here. So we have order pairing down here. So where should your eye go when you hit that external range? Again, internal range, right? We have this fair value gap over here. So after external range liquidity has been taken, we want to go to internal range over here. And eventually we fill up this whole fair value gap over here. Now, how does that order pairing look like on a daily chart? Right, so we start off with that sell stops over here, that old low on the monthly chart. On the daily, we have a clean swing low formed down here below this low, and then we're breaking up structure again over here, breaking here, and then continuing down into discount over here, and then continuing up. So where do they sell their buy stops? They sell it above market price, right? So we have that monthly fair value gap fill over here. Buy stops are resting above this high. They push price up and then they offload their buy orders from these sell stops into this buy stops over here.